Investors looking to grow their money are always trying to find companies that are good businesses at temporary lows in order to get outsized returns over time. One such company that I've agreed to cover as a viewer request is Dollar General. They've crashed more than 50% year to date in 2023. Retail's been getting hit hard. Dollar General's been getting hit by Mike freaking Tyson, okay, guys? Wow. If you look at the annual income statements for Dollar General, you see that they are definitely a company that has had a focus on rewarding shareholders. And there's definitely some positive trends at work. So the first thing is, of course, the consistent growing revenue. Not every single year was a grand slam, but if you average it out, they managed to grow revenue at a rate that's pretty darn good for just a simple brick and mortar retailer. The second thing is honestly the rate of share repurchases. That share count has decreased by close to 30% since 2014. That's pretty darn impressive. And finally, the dividend. They established it looks like in 2015, and have grown it from 88 cents per share up to $2.20 per share in 2022. That's a really impressive dividend growth rate. If you look at the last couple quarters, this is where some problems start to show up for Dollar General. If you look, the EPS is down over 28% from the comparable quarter, and the profit margins have fallen from an average of 5.5 to 6.5% down to 4.79%. That loss of margins was definitely significant, causing their EPS to drop by 28%, and their same store sales also decreased by 0.1%. This means that the sales growth that they got was mainly just from new stores, which is not the ideal scenario for a retail company. Forward guidance for Dollar General has also been downgraded by management. Net sales growth is being guided lower, as well as same store sales growth. It's expected now to land between -1% and +1%, compared to previous expectations of 1 to 2%. Diluted EPS is expected to land between 7.10 and 8.30 per share, which is a decline of between 22 and 34%. They are citing softer sales trends, aka recession, or expected inventory shrink, aka shoplifting. If you were thinking it's all doom and gloom, think again. After the current headwinds perhaps dissipate, analysts expect for Dollar General's EPS to start on the path to growth once more. In fact, they're projecting it will go from $7.98 per share all the way up to a staggering $18.12 per share. Now, that's what I call growth. Also, although I would never hang my hat on the price predictions of analysts, I think that the 12-month price forecasts we're seeing indicate something interesting. With a low price forecast from analysts of $102 per share, I think that that pretty much indicates that at least the analysts believe that we're pretty much at the low and the worst is just about behind us on this. Now, do I think that a high expectation in 12 months of $270 is realistic? I remain a little bit skeptical on that one. Looking at those analyst price targets, of course, begs the question: is Dollar General in the realm of reasonable at today's prices? Let's face facts. Brick and mortar retail isn't exactly the easiest business to thrive in. They rely a lot on foot traffic, and they have to get by on razor thin margins in a lot of cases. Those razor thin margins are under attack from every side. For example, you have the recent uptick in shrink, or as I call it, shoplifting. Some refer to it as retail theft. New companies like the e commerce giant Amazon delivering basically anything you can imagine straight to your door in a day or two just by going online and pressing checkout. Though, even with those factors going against it, there is probably a price to pay when evaluating Dollar General as an investment. It's just about taking those factors into account and making sure that you pay the right price for this stock. When I run a DCF on Guru Focus, it turns out if you would be happy making 10 or even 11% on this stock in the long run, it's probably an okay entry point right now. My assumptions are pretty simple. I would be assuming that we would be rebuilding from about $8 per share in earnings, which is about where the guidance and the estimates land. It's somewhere in that range. That this is pretty close to the bottom here, and that's what we would be rebuilding from. I'm assuming the rate of rebuilding the earnings back up to higher levels and then continuing to grow would be done over a longer period of time than what they're saying. There are some years where they're projecting pretty large leaps up to 15, 16, even $18 in the next few years. I think going from 8 back up to there is probably going to take a little bit longer. So I'm assuming something like a 7.5% year average for the next, say, 10 years, dropping down to maybe 5% growth after that point. Something a little bit more steady and reasonable, maybe factoring in a few underperforming years in there. It should all average out. That being said, I personally, to take on something like Dollar General, I wouldn't be interested in a 10 or 11% desired rate of return. I would want at least a 12.5% rate of return to take on some of the risk. We talked about the headwinds in the video, and to take that on, I would want to get a solidly market beating return in order to assume that risk. So for me, it seems like the magic number is probably under $100 for me to start to truly consider Dollar General. As a bonus, I'll go over the 8 pillars from Everything Money on this stock and what I think they say about the business. So, for context, their only two X's are the cash flow growth over 5 years, which makes sense because cash flow has been compressed recently by that dip in margins, fueled partly by retail theft and higher costs. Their long term liabilities as a ratio to their 5 year average free cash flow are also relatively high at 12.6. This puts them in about the same range as Walgreens, slightly worse than Kroger, slightly better than Albertsons, and about twice the level of something like Target, 3 times that of Walmart, and 6 times that of Costco. That means if they don't manage to get their free cash flow back on track, they could run into some trouble with managing their liabilities. Also, for fun, I ran my assumptions through the Everything Money Stock Analyzer tool. I assumed between 2 and 5% rev growth, profit margins between 5 and 6%, free cash flow between 4.5 and 5.5%, PE 10 to 12, price to free cash flow 11 to 13, and a return between 11 and 13. The results I got were actually kind of surprising. Before we conclude, I'd just like to remind you to like and subscribe. It really helps the channel out a lot. Now, we came out with numbers relatively close to my DCF, with values ranging from 85 up to 128, with a mid range in the low 100s, which again brings me back to the conclusion that sub 100 is probably where I personally would want to be on this stock. If my low assumptions came true at today's prices, you'd make about 7%, mid just under 11%, and high just over 14%. All that being said, your outputs will only be as good as the assumptions you made about the future, and nobody can absolutely know the future. So, whether or not you agree with my prices really depends what you think about the future of this company. Make sure to let me know down below in the comments if you agree with my assumptions or not, or even better yet, join the Discord, link in the description, or come on Saturday nights at 8 p.m. and watch us live on the Cash Flow Kings, link in the description. Take it easy, everyone. Have a wonderful weekend.